There we go. Oh, there we're good now. Thanks for a reminder, Keon. Could have came about 3 minutes and 37 seconds earlier, but better late than never. But yeah, so anyway, what he's talking about, if you want to look that up, we have access to it on the Peak through whatever one they use, and then also yeah, what he's talking about, flight to quality. Basically, the easiest way to think of it is under normal circumstances, generally, if the stock market's doing well, usually the bond market's doing poorly, and vice versa. So not always, but sometimes. That's usually the case.
It will come out maybe at 9, 9:30, 10, 10:30, 11 Eastern time, whatever it is. And during that time.
Oh, and one last thing on that is our rates usually come out at about 8 o'clock, roughly 8 o'clock a.m. So if you're ever looking at whether we're going to get a intraday reprice for the worst or better, just look at when rates came out relative to where pricing is then. If you have MBS Highway, you can set times. So I would probably set times right around when our rates could normally come out.
Some of the activity that's transpired in the bond market will be already baked in to the pricing you receive. So it's not the change on the day that you want to be most concerned about. You want to be concerned with what is the change from when you received your pricing. Now, international stock markets, they can have an impact too. In London, the stock exchange there, and the European markets, they close roughly for the US around 11:30 a.m. Eastern. And the way that market interacts or closes can have an impact on the US stock market at that time. And then specialists that are on the floor of the stock exchange that really help to make prices more stable and match up buyers and sellers, they leave at 3:30, which means that the last half hour can be a little bit rocky. Sometimes you've seen this where prices all of a sudden the last half hour make these big moves. That's because the specialists have left, and you can expect a little more volatility during those times. Now, the Fed's another aspect of this, and the Fed can come in and they can buy mortgage-backed securities during the day. They've been doing a lot of that in recent years. And they're going to have their operations, which are conducted by the New York Fed, between 11 and 2:30 typically. So 11 a.m. Eastern to 2:30, which means if they start buying at 11 a.m., well, you could see a nice little move in prices. If they stop buying at 2:30 p.m., you could see prices drift a little bit more without that safety net of the additional Fed buying that will help support bond prices. So all things we need to be cognizant of, especially if we're watching volatility, and we need to be very careful. Now, there's bulls and there's bears. What is a bull? A bullish environment is when that particular market is moving higher. A bearish environment is where prices are moving lower. Now, what constitutes something called a bear market? Well, the first thing is if the market declines from its peak by 10%, that's called correction territory. But if it declines by 20%, then it's called a bear market. Now, here's an interesting fact, and I bet you it's one that even your stockbroker doesn't know. Why is it called a bull market? Why is it called a bear market? And I'll tell you why. It's because the way the animal attacks. Think about a bull. With its horns, it's going to attack in an upward thrusting motion. Bull markets go up. How does a bear attack? A bear attacks with its claws in a downward thrusting motion. So markets that go down are bear markets. Little something to know.
That's pretty straightforward. I think, but anybody have any questions on that? It's just, there's not a direct correlation between the stock market and the bond market, but what's good to understand is timing of the market. So you have what's called a flight to quality, which is where people pull money out of the stock market, put it into more safe haven assets like bonds. That's going to generally push bond prices up, interest rates down. But there's a phenomenon in the stock market called sell and may and go away. Anybody heard that? Anybody? No. Okay. So stocks, you own a stock forever that goes up or down. It's not really, you don't really realize any gains. That's the terminology we use, but it's not really real until you actually sell that stock. But what you'll see a lot of money market or traders will do is they'll take profits around May, June. So any money they made or any profit that they made in the stock market, they'll move that money over to the bond market. So they kind of lock in those gains, and then they'll buy again when the market starts moving up again. But that's how they lock in money. So you might hear me or overhear me talking to my clients about me thinking that inflation may improve by next May, or next April to June. When that happens, we'll also have the benefit of that whole sell in May and go away phenomenon. So if inflation comes down and people start moving their money into bonds again, like from stocks, the stock market rallies again, we will see kind of a synergistic effect on bond prices and interest rates. So when you hear me tell people around May or June, the reason I'm mentioning that, aside from the inflation aspect, is because of this additional phenomenon that could help compound the effect. So let me jump on to the next one. But yeah, there's not a whole lot there.
Yeah, I was just curious about the what on the peak is the mortgage-backed securities, because I cannot find it. I'm looking type in the search maybe. I'll figure out from somewhere else. Never mind. We just keep moving.
Huh? Okay, I'll show you later.
Joshua.
Hold on.
Josh, I had a quick question.
Yeah.
So I've known for a while when the money goes from the stock to the bonds, that's going to lower the interest rates. And I've had this explained to me before, but I forgot why, when the money goes into the bonds, why does the interest rate get lower? And I know
the basic overview of that is there's an inverse correlation or inverse relationship between bond prices and interest rates or yields. So if bond prices go up, the interest rate on that bond goes down. Now, when you take money out of stocks and put it into bonds, you're increasing the demand for bonds, right? So anytime you increase demand, the rules of supply and demand tell us that the price is going to go up. So if the price goes up, the interest rate, which is inversely
yield,
that inverse relationship, will push rates down. Now, we went over that before of why that is and how that interest rate works and how the yield curve works. But you can actually go back, have Nicole send you just all of the modules, but that's actually a really good one to watch. And it goes a lot more in depth, but basically it has to do with something called capital appreciation. So yeah, basically that's why, because the demand's going up for bonds, pushing the rates down. And I forgot I didn't do this, so hold on here. No other questions we had right there? All right, we have to do this thing, right? This final assessment. So actually we'll have everybody kind of pitch in here. You guys are still seeing this, right?
Yep.
Okay, so I'll let you guys give me an answer. So which best describes the relationship between bond price and yield?
D, final answer.
Everybody else? Okay. What is a mortgage-backed security?
C.
I was going to let answer. Just Jared? Correct. True or false? Treasury yields are backed by the full faith and credit of U.S. government and considered risk-free at maturity.
True.
True. Keyword there is at maturity. A stock is a debt instrument, unlike bonds where you have ownership.
False.
False. Exactly the opposite. True or false? 30-year mortgage rates are based off the 10-year treasury yield.
False.
Which of the following best describes the relationship between mortgage-backed securities and treasuries? What was it? Okay, yeah. Which of the following has the longest maturity?
D.
Adult males.
That's the shortest.
Yeah, bills, notes, bonds.
Yes, 10 years or more. Why is there a bond coupon rollover month every month? I can help with that if anybody else. This is B. So mortgage bonds are finite. They have a set maturity date. So you're going to have a turnover every single month as those mature. What do X? What's X? X, this number. What is this number?
Coupon.
The yield, coupon rate.
Coupon rate, yeah.
Right.
And then let me see here. There we go. And what's the coupon rate on a bond?
The actual stated interest you receive at maturity, or every whatever, the actual interest earned on
The whole security.
the original price, whatever the
Yes.
original price is.
Yeah, so this is it's the fixed rate of return that the investors are going to receive. So on like a 2.5% bond coupon, it's probably a 3.5% rate that the mortgages that are making up that MBS
On average.
on average, yeah. So I mean, right around there.
Fixed rate of return investors receive.
Yeah.
Got it.
A bond is trading above par when, or a bond that is trading above par is at a
Discount. Yeah. No, it's a premium. Low par is a discount.
there you
Oh.
Discounted premiums, they both sound positive. It's kind of just weird.
go. No, premium is you're paying more. You're paying a premium. It's not like a premium bond that you're buying. It's not referring to quality. If a bond is held to maturity, an investor can expect to receive.
C.
Yeah.
I think, Keon, you have like the worst microphone on the planet in your office. I can barely hear you. Which of the following is true? Yeah, that's 1,000 times better.
Here we go.
Oh, which of the following is true of interest rates and their corresponding bond price?
C.
C.
There you go.
A lot of questions.
No, there's a lot of them. True or false? The bond is at a premium when the current yield and the yield to maturity are lower than the coupon rate.
False.
The bond is, yeah. True or false? The effective interest rate fails to consider compound interest.
True. Right?
I don't know. I forgot. So
I don't know this
What
one.
were the? Can you cover the two other ones? I know we're like going through like a test, but
Yeah, no, that's true. Because compounding is, it's not considering you reinvesting. So
Yeah, so the effective rate does consider a compound interest rate. The nominal interest rate does not.
oh well. That's just
okay.
two
got it.
words. Yeah, okay. Where's
So nominal.
The real before taking inflation, that's yeah. Before taking inflation into account. So
that's nominal. Yeah, nominal.
real interest rate subtracts the rate of inflation from the nominal interest rate. Yeah, or you guys answer.
Real interest rate subtracts.
What is more sensitive to a loss in buying? What is more sensitive to a loss in buying power due to inflation rising a longer term? Oh,
A.
Longer term. Yeah.
as what?
More sensitive.
Compounding.
Oh, okay.
What is the driving force that starts the convexity buying cycle? Okay. C.
Um,
So as I don't want to get too far into this, but we talked about it as money managers, so bond managers are going to try to buy different bonds with different maturities so that when some of them get refinanced, so if you either have a callable bond or if you have bonds that can be refinanced, like mortgage bonds that are likely to be refinanced, if let's say you have a bunch of 30-year mortgages that you're expecting to have like a 10 or 7 to 10 year lifespan and rates are going down, it's much more likely that those are going to be refinanced quicker. So those are going to come off your books. So your longer term yields, like whatever you're investing in for those longer term yields, is going to push out the average duration of those bonds. So that's why, so as people start refinancing, that starts that convexity buying.
so the driving force is reduction in your overall portfolio timeline.
Yes, if you think about it like the average. So like when people pay off credit cards or when people close credit cards, it doesn't really matter that much if they are closing a credit card they've had for a year, but if they close a credit card they've had open for 20 years, that's going to decrease the average length of credit history. So that's why we tell people don't close credit cards, aside from the fact that you're removing open credit or available credit. But that's kind of the same concept. You're reducing the average. How does a fund manager whose portfolio has a mix of mortgage bonds and treasuries rebalance their portfolio if the duration of their mortgage bond holdings shrink? So this is the second thing.
B, I'm guessing.
So when you said B, is that Darren?
No,
Good
I
job.
was saying D. So
Oh, D. Well, that's gonna increase the length. So if you're shortening them, if they purchase longer term, actually, sorry, no, you're right. So if you purchase more longer term treasuries and the other ones are shorter, that will balance it out. So yes, you're right. If a bond has a maturity of 5 years and subsequent maturity of 5 years, subsequent rates rise 2%, what is the approximate impact to the bondholder? Remember compounding?
Negative impact of 10%.
There we go. What is a callable bond?
Bond that can be refinanced or paid off. See,
Good job. The 100-year Austrian bond had a yield of 0.88 in mid-2000. Why would there be a demand for this instrument with such a low yield awarded for such a long-term investment?
C.
Anybody else? Yeah, Jared, you're right.
I agree. Yeah.
Yeah, because 0.88 over 100 years. Let's just do that real quick.
We should have bought some of those.
I did, you didn't?
No, I did not.
88% return. What the heck?
what
What happened there? What just happened?
we lost it all.
Oh, wow. Did we just start over?
Now try it. No, it's oh.
Oh,
Go to the
Oh.
next. See if you can skip through.
Fail. Damn.
oh, motherfucker.
What the hell?
Oh,
Okay, well,
right.
just
well,
call it.
yeah. Yeah, I'll just go through this and do this for you. But yeah.
We got 15 minutes left.
Okay, for 15 minutes, I'm going to go actually and show you where to go mortgage-backed securities. Any questions on any of the concepts that we just were talking about?
Did you actually buy Austria bonds?
No, I had never even heard of that before
Oh.
until this. All right, so
Well, next time Bangladesh comes out with their bond, we'll be right there.
Yep.
I bet Sri Lanka, dude, they're struggling. They're going to come out with like 1,000-year bond.
I have no idea what you're talking about. But Sri Lanka that's the place where you have to go through like a closet to get to, right?
No,
Narnia.
it's
Narnia.
it's something similar to that. Yeah.
Okay, where was it used to be right on the front page. Oh, here we go. Mortgage News Daily. So click on that.
Mortgage News Daily.
Yeah, so you can go on mortgage rates, I think, or one of these actually. I think you just go here. Yeah, there you go. Somewhere MBS data, subsidies, MBS prices, but yeah. So this is the coupon we're following right now anyway. So you got the 4.5% coupon, and we talked about why we're not necessarily looking at the 5% coupon, even though that's actually closer. Anybody remember that? It has to do with liquidity in the bond market. So remember our mortgage rates, and this is for Ginnie Mae's, these are going to be for your Fannie, Freddie, or sorry, FHA, VA mortgages. But so remember what mortgage-backed securities are. So we're packaging up loans, let's say at 6%. So we're doing a bunch of loans. We're going to put those together with a bunch of other loans at 6% with similar credit profiles, similar credit scores, down payment, all of that. We're going to send it off to Fannie Mae. They're going to package it together with a bunch of other loans from Bank of America and Wells Fargo with the same similar rate credit profile. They're going to bundle those all up. They create what? Jared? What do they call it?
I totally wasn't paying attention. I'm sorry.
SPE is what does that stand for? Special purpose entity. But it's basically like an LLC that you can buy shares of. So your 401k, your mutual funds, they're going to be buying shares that are going to pay a fixed rate of return. So let's say if all the bundled mortgages are at 6%, the coupon on that might be 5%. So typically the servicer is going to get paid about 30 basis points per year to collect the monthly payments, pay out the bondholders. The rest of the money goes to the mortgage bankers or brokers like us, the Fannie Mae, Freddie Mac, to the investment bankers that kind of get these out there on Wall Street. But that's where the difference in that 1% comes from. So the amount of people that are willing to, or the amount of mortgage-backed securities that they can put these mortgages into, the higher you go in interest rate, the higher you go in yield, the less it takes some time for the markets to adjust and for people to want to buy those, because that could screw up like those money managers that are going to buy these longer term maturities. If somebody has a much higher rate, what do you think that would happen if rates drop by a percentage, like 1%?
They're gonna refinance.
Every single person that we did is going to refinance. Like every single person we've done a loan for recently is refinancing, and it's going to happen. So everybody we're doing purchases for today, we're going to refinance in the future. That's why you want to make sure you keep it in front of your database. But the investors know this too. So same thing with like non-QM loans or hard money. They know that you're going to try to get out of that loan as quickly as possible. So they're going to try to collect their yield up front, and that's where you pay points, or they're going to do borrower paid comp, but no lender paid comp. Or there's going to be like a longer term for the early payoff. Somebody saying something?
Prepayment penalty.
Yeah, or prepayment penalty, exactly. So you can't have a prepayment, and that's why a lot of them won't do, that's why you have their business purpose loans. And that's also why a lot of hard money lenders will not do a primary residence, because they fall under Dodd-Frank and you can't have a prepayment penalty. So it has to be like an investment property so that they can charge that prepayment penalty, or a business purpose loan is another way that you get around that. If you pull up a deed of trust, if you look at the riders, usually you'll see like the other riders and it'll say prepayment penalty or business purpose loan, or BPL. That's how you know that. So, so if you're ever looking at specific types of loans, like me and Dustin were looking at yesterday and calling on, if you're going after a market that is open, that generally has those prepayment penalties, or that business purpose loan that can have those prepayment penalties, you also want to pull that rider just to make sure that if you refinance that person, that they're not going to be subject to the prepayment penalty, or it's worth it. Because most of the time it's either going to be like in residential real estate, it's going to be like a 3-2-1, meaning like for the first 3 years, it'll be, if you refinance in year 1, it's 3%. So you pay like a 3-point penalty. Year 2 is 2, year 3 is 1, or you'll have a set period of time. So usually 24 to 36 months, sometimes a little bit longer, and you'll pay like 6 months of interest. And the prepayment doesn't mean you have to pay off the loan entirely. It's typically only 20%. If you pay more than 20% of the balance off, it triggers. So any questions there? Oh, well, I didn't go too far into that. So
I kind of have like a general kind of statement question. Like today, Robin was talking about how she like never goes on this type of stuff. She doesn't look at it at all.
Yeah.
But it's a totally different market, obviously, in Oregon. Like, do you think like in San Diego with the size of the market, like it's important to be like really studious and really like engage with this type of stuff more so in like different markets?
I don't know if it's about the market. It's just about your client base and how you sell yourself. So I sell myself as an expert. Robin is amazing loan officer. She's got her entire like branch down, just the operational portion of it down. But if you do a loan with Robin, I don't know if you've ever sent a loan to her for somebody else to, or for her to do, she doesn't talk to anybody. Like you'll never get a hold, like the borrower will never talk to them. They're going to talk to the team. So
Right.
she's not trying to get in front of those people to sell herself as an expert. She's gotten in front of her realtors well enough so that they sell her, which is that's the idea. And that's where you really want to be. But let me go here. I'll tell you, for me, it's probably one of the most useful tools that I've used. I mean, I've never quantified how much money I've saved, but I can tell you, like there's been several times where I see more, like, so right now we're down 14 basis points from 11 a.m. Eastern time, right? So that's about when rates came out. If I was locking today and we didn't get an adjustment, like there's a possibility we could get an adjustment here. But if I saw this fall down to like minus 45 basis points, you have a window, usually about 5 to 10 minutes, sometimes a little bit longer, where you can get ahead of the market or ahead of secondary.
Yeah.
And if I had to guess, it'd probably say, having this in front of me, probably saving about $50,000 a year. For my clients, $50,000 a year. And probably me $50,000 a year just in not having to do price or what do you call it, PEPs? Yeah. So this is important, but you don't have to get into it as much. Just as long as you know how the markets work and you're following this, that's about as deep as you most will need to get. This is part of my professional home buyer presentation. So what I'm trying to do is not to teach people how to read this in that presentation. I'm trying to teach them, to show them that I know what I'm looking at and get their okay to lock when I feel is the right time. And by doing that and showing them this, what I'm also accomplishing is showing them how much rates change day, like even intraday. So I'm trying to preemptively stop that conversation or address that.
It's not funding's rates, it's the market's rates.
The market's rates, yeah. So if you talk to me right now and you talk to somebody tomorrow at the same time and somebody else, my rates are probably changing with their rates. So whatever the market's doing tomorrow, it's happening to me and the other person. So you might as well just talk to me, because I'm going to show you that I know how to read this. I can tell you, but okay, I can tell you what I'm looking at when I'm reading stochastics. I can tell you what Fibonacci retracement levels are and simple moving averages. This is if you wanted me to talk to you about inverted hammer formation or bearish hammer formation, like I can talk to you about that all day. Sure, you don't probably want to know about it, but what I can tell you is that I'm watching this in real time. Every other loan officer you're going to talk to is going to be following this, the 10-year treasury. And I'll go over like a 2-minute explanation of how these are not directly correlated. But I'll tell them, okay, so when I'm following this, if I was looking at the 10-year US treasury, I know what's happening in real time. They're going to find out tomorrow. So every time you talk to somebody that's not an expert, somebody that's not me, they're going to be going off of yesterday's information. I'm following this in real time to protect you against any intraday movement. Nobody else is going to be able to do that. If they can, great. I'd love to meet them, love to talk to them, because we'd have a great time and probably be best friends, but nobody else wants to do any of this. So if you're okay with it, I know we're not locked right now, but just given the fact that it's Friday and we're now going to be trading it within this really narrow margin, and we do have a dual floor of support here. If I have the okay on Tuesday morning, I'm going to take a look and I'm going to lock in. So whatever the case is, I'm going to just try to get them to get that's me talking to the client. I'm going to try to get their sign on to make their locking decision for them. That way, if they say, "Oh, you locked too early" or whatever, like you gave me the permission to lock. You know I'm following this. I have a degree in economics. You don't have to use that if that's not true. But let me do all the thinking for you when it comes to this stuff. You just think about what furniture you want in your new house. Cool. So, but yeah, I'll do. We only got 3 minutes left, so Any questions? Because I'll redo all those other questions. That was annoying. Got 3 minutes. Alien's coming in here. Oh yeah, by the way, in case nobody heard, new mileage rates for the IRS. So starting in July, we bumped it up because gas is so expensive. So halfway through the year, 62.5 cents. I do need to look up the depreciation portion of the business mileage. I have not looked that up yet. Anybody happen to know that?
No.
Everybody knows why we add back a certain number of miles per
schedule.
business.
Yeah.
Everybody knows why though? It's because that's the depreciation portion. So if you take the standard mileage rate, the IRS attributes a certain portion to depreciation, and we can add depreciation back, right? For most investors. So any investor we can add depreciation back, we can add a certain number of miles because it's the depreciation portion of that standard mileage rate. This is like something that the why behind it's important because I've had other banks, even here, different underwriting pods, they don't understand that. And if anybody knows tax returns, like if you're looking at Schedule C, sometimes people have it on Schedule C on page 2. But a lot of times if you have any kind of listed equipment or if you have anything that's used more than 50% for business use, typically you're supposed to capitalize that asset and you're supposed to put it on a form 4562. So IRS form 4562, page 2. So if you do that, especially if you have multiple vehicles, so you have to do if you have multiple vehicles. But that's important too, because technically by IRS standards, if you fall below 50% utilization, then there's a gain. There's a certain gain that's created by the depreciation portion that you took or depreciation you took on that. It's called Section 1231 gain. I don't know if anybody cares about that, but the why has allowed me to argue with underwriters why we can add it back on the 4562 and it's not on page 2 of the Schedule C, because that's what all like, oh, but it's not on the sheet. I don't understand anything that's not on the sheet. It's like, well, just fucking learn stuff. It's not that hard to brain still works outside that one sheet. But anyway, thanks guys. We'll knock it out next time and we'll get a little bit further.
Cool.
Thank
Cool.
you.
Thank you.